welcome. Take your seats and we'll get started. Going to talk about what we're seeing in the market. So, what's happening in this crazy market, right? I think, I've been around now in year 40 doing this, which I can't believe. And I will say that in some ways, I feel as if I'm starting my career all over again, based on what's happening with technology. I think that AI and technology is basically changing everything. And so I'm starting my career over. I just happen to have a 40-year track record behind me to help me, but basically I think we're all starting our careers over based on what's happening with technology. But if we look at what's happened, and I think it's important, I always talk with statistics, but I think that statistics themselves, absolute numbers, are really not that meaningful. What's meaningful is the relationship that those numbers have to other numbers. Are they going up? Are they going down? And by how much are they going up or going down? So I always like to give relative perspective, and it's very, very clear if you look at any metrics. And the metrics that are on the board and the metrics that JLL tracks are transactions over $10 million in the Manhattan market. And Manhattan south of 96th on the east side, south of 110 on the west side. But whether you look at all transactions over 500,000, you look at transactions over 10 million, you look at any segment of the market, it is very, very clear the peak of the market activity was in 2014 and 2015. In 2014, if you just look at all transactions over 500,000, we had more buildings sell in 2014 than ever before in the history of New York City. 5,534 buildings were sold. That was an all-time record by more than 10%. That still stands to this day. In 2015, we had $80.1 billion in sales volume. That was also an all-time record. If you look at these statistics, which are just simply Manhattan, those were citywide over 500,000. For Manhattan, you had peaks were in 2015 for both number of sales and for dollar volume. And clearly that was a great time. We knew that the market was transitioning. In the first couple of weeks of October of 2015, there was a very tangible, profound shift in the market. And what was that shift? We saw two product segments that were being disrupted. One, we have 40 or 50 development sites on the market at any one time. All of a sudden, we saw the bids that we were expecting were coming in 15 to 20% below what the expectation was. And then in the hotel sector, we saw the cap rates all of a sudden were up 75 or 100 basis points. And why are those two segments something that are bellwethers for what's happening in the market? Because when the market changes direction, those are the first two market segments that will change. Why? Hotels, because hotel leases are for one day, highly reactive to the market, and land is a proxy for what developers believe market conditions are going to be like 3 or 4 years from today, when what they're buying will be built, will come to market, they'll have to rent it, sell it, whatever. So it's an indication of the perspective that the development community has on the future. So when we saw these two highly correlated sectors to changes in the market shifting very significantly, we knew that it was over. And I remember Hags and I were having a conversation, it was mid-October, and we're like, you know what, the market's over. And we had a couple of development sites that we were in the process, we had been hired to sell them, we were putting the OMs together, and we're like, we have to go tell the client, we're not going to get this pricing. And went to the client, and they're like, what are you talking about? The market's great. I said, no, you know what? It's changed. And so from the beginning of October of 2015 through February of 2020, the market had seen a correction. And the dollar volume of sales over that period of time had fallen by 56%. The number of properties sold fell by 54%. And then March of 2020, COVID comes along and converts this mostly volume correction into a value correction. And over that period of time, from October of 15 through February of 20, values were down by about 12% only. So disproportionately, we were negatively impacted on the volume side. But values were down a little bit. But COVID comes along, and values start to plummet, particularly in Manhattan. And one of the interesting things within New York City is that when things happen, they are magnified in Manhattan versus the outer boroughs. The market in the outer boroughs is much more stable. So when things are good, things are disproportionately better in Manhattan. When things are bad, they're disproportionately worse in Manhattan. Boroughs much more stable, but what we saw was that values in some sectors in Manhattan were down by as much as 50%. Retail, land, hotels. It really was a tough, tough time. So clearly 2020 was the bottom of the market. But then we hit April of 2021, and the first week of April, the phone starts ringing, and it's all private equity firms calling. And we got called by 13 private equity firms over a 3-day period. Hey, Bob, we've been on the sidelines. We haven't deployed any capital. We have a ton of cash. We want to get back into the market. Who's buying? Who's developing? Who can we give money to? And I'm like, what the heck is going on? What is making all this happen? And as it turns out, it was the first quarter reports that were published by the residential brokers that led to this optimism, because those reports showed that for the first time in many years, there was upward pressure on residential rents. For the first time in many years, there was good condo absorption. And so we went through this period where from the second half of 21 and the first half of 22, I thought, oh, great, we're finally out of this thing. And who wouldn't have thought we were coming out of it, because we had just gone through the longest correction that we'd ever seen. You know, the other corrections that I've lived through and witnessed, the S&L crisis in the early 90s, which was 4 years, the recession in the early 2000s, and then the GFC. And the S&L crisis was clearly the longest correction that we had seen in 4 years. This correction was even longer, so I said, hey, we're out of the woods. This is great. We're coming out of it. We're coming back. It's about time. And then March of 22, Fed starts raising interest rates. Doesn't really impact the real estate market until August and September, but August and September, spreads start increasing and the downward pressure starts again. So what I'm trying to figure out now is, are we still in the same correction that started in October of 2015, and we just had a 12-month vacation from it, or are we in a whole nother correction, which would be the fifth correction? I'm leaning towards it being a whole new correction based on a different set of dynamics that we have. But the fact is that we are in another correction now caused by interest rates. And interest rates, you know, everybody's talking about interest rates today, and I'm skipping ahead a little bit. One of the big risk factors in the market today is refinance risk. And the fact is that most refinancings are not producing the same proceeds that were currently on the property. That is a big issue for everybody. But what the interest rates have done, and I think it's important to recognize also, I think the Fed completely misdiagnosed what the problem with the economy was. And that the Fed's reaction was as if the employment market was completely overheated. I don't think it was overheated. I think it was undersupplied. And so think about it. If you went to your doctor and you had disease A, and the doctor says, oh, you have disease B, and I'm going to aggressively treat you for disease B, you wouldn't be in such great shape. And I think that's what's actually happening with the Fed. And don't forget, the Fed's just a bunch of human beings. You know, they're subject to making mistakes. So, you know, I think that it's been misdiagnosed. I think the interest rate increases have been too sharp and were implemented too quickly. And the fact is, some people are saying, well, gee, with the interest rates increasing the way they have, how come the economy is still doing okay? Well, the fact is, in our economy, only 20% of our economy is sensitive to interest rate changes. 35% of our economy is government and healthcare. So think about those two segments. If you need open heart surgery, you're going to say, hey, I'm going to hold off, interest rates are too high. Right? So people are making decisions. There's pent-up demand. During the pandemic, people didn't do a lot of stuff. You didn't do elective surgery. You didn't do things. And now that is catching up with the market, and people are doing stuff. And you look at government payrolls. The federal government payroll has increased. State and local payrolls are increasing. So the economy is chugging along pretty well because interest rates only impact about 20% of our economy. Unfortunately for us, interest rates are highly, highly correlated to what happens in the real estate market.